press the button.
down
Yeah. Okay. Should all be okay. Have you given this talk a bit, or is this?
Yeah, a couple of times.
A couple of times.
Well, yeah, a few times. It'll be right.
Yeah, no. I'm sure it will be. I'm sure it will be. You okay? Okay, good morning everybody. Nice to see you here for our fourth instalment. It's the fourth instalment, isn't it, of our industry expert lectures. Last week we had Dilek Ulu, who's from Invesco Perpetual, who was talking about the multi-asset fund on the investment side. And this week I'm really pleased that we've got two more people from Invesco Perpetual. We've got Mike Marshall, who's on the risk side of that, so on multi-asset funds. So it's going to be interesting to hear what he has to say. I think Dilek gave us one or two questions for you, actually.
Oh, really?
Yeah. So I'm going to try and remember what those are. Okay. And also we've got James, who's the investment officer director, who's going to talk to us first. Okay. So yeah, listen up. Save questions, I think, to the end of your presentation. Is that right, James?
Yeah, I think so.
Absolutely. So the floor is yours.
Thanks. Okay, good morning, everyone. So yeah, James Kennedy. I've been in Invesco Perpetual for around 14 years now. I'm one of the management team responsible for the investment centre that we run in Henley. That is responsible for about $150 billion in total. We're part of the European region of Invesco's business. In Europe, we're responsible for about $260 billion of our clients' money, and the global group just short of $1 trillion. So, just to give you an idea of the sort of scale. I'm the corporate guy, so my slides are a bit more about the, I'm assuming a sort of fairly sort of low base of knowledge, so I'll ask for forgiveness already, and I'll just sort of whiz through the sort of basics around the financial services industry, and then a bit more about investment management, and then a bit about us as a firm. And then I'll hand over to Mike, who will give you a more investment-centered perspective. So I think what we'll do is I'll just sort of work my way through the content. If you have a burning question, then please do ask. But just to make sure that we allow time for Mike's bit, what we were thinking is that we'd both sort of come back to the front and just take whatever questions we will cover at the end, and we'll allow that time to. Okay, so if we just start with the financial services sector, so through the global financial crisis, the industry came in for quite a lot of criticism, and I think quite a lot of that would be fair. I think you don't have a situation where the regulators are imposing the size of the fines on some organisations, the kind of scale, and the reasons underpinning it without there being a genuine conduct behavioural problem. But I think what I would try and assert now is don't throw the baby out with the bathwater in terms of the value and the social importance of the financial services industry. Done well, and when I mean done well, I mean where you put our clients' interests first and the interests of the company, the corporate second. The finance industry can provide enormous social value, what I'd say. So, the process of capitalism can be very effective in providing valuable finance that enables new products, new ideas, new services to be given life and given extension and reach. So the best example I can think of is I don't think you'd have the smartphones in your pockets today if it wasn't for the dot-com so-called bubble of the early 2000s. The amount of capital that flowed into subsidizing a lot of the technology infrastructure and things like the PCs, etc., that enabled a move of that kind of technology, a sort of a connected technology from universities and from military purposes into general society. That process was vastly accelerated by this flow of capital into technology businesses. And yes, the providers of that capital, shareholders and people who bought the bonds, the debt of these companies, did suffer when things went wrong, but the consequential effect of the growth of economies throughout the world as a result of that technology has sort of given a long growth engine or kind of capability to the global economy. So once you've got new products and services being developed, it's also a mechanism whereby products and services that are less applicable or in decline can be wound up sensibly over time, and where you get distortions of that through protectionism, you see waste, and that acts as a drag to growth commonly. But if you've got a reasonably well-functioning economic system, it produces jobs. That provides for tax revenue and eventually feeds into obviously education, healthcare, etc. Individuals want to start to store that wealth for a point in time when they're not earning an income, so pensions, and you need a facility or mechanism by which that wealth can be stored. Then you, as you're going through life, also need capabilities that help you protect yourself, your family, and your possessions. So you'll need things like insurance. All of these things are things that the financial services industry seek to provide. So I just wanted to quickly go through some of the components of the financial services sector. Commercial banks, that's the obvious place to start. That's your high street bank. It's where we all, I'm sure, have bank accounts, current accounts, savings accounts. It's where we might go for a personal loan. It's where companies will utilize similar kind of services but for a corporate nature. These are the sort of organizations that assist the day-to-day transactional nature of life. It's just the sort of tracks and the basic infrastructure. Investment banks are organizations that, simply put, in my view, seek to marry up the consumers of capital with the providers of capital. The consumers of capital on a large scale are going to be governments and major institutions and large organizations. And they'll want to raise capital through debt markets, so want to borrow money, and some companies will want to raise capital via issuing shares through the equity markets. But they need a broker, they need a middleman to access the providers of capital, i.e. the savers. And in economies, you have people saving, retirement, short-term savings, whatever it is. These things need to be aggregated up on such a scale that you can make good the scale of the borrowing or the capital raising that large institutions are doing. So the investment banks, they're the kind of infamous ones, I guess, through the financial crisis, because as they were going through that process of marrying up the consumption of capital and the provision of capital, they were making absolutely certain that the risks involved were coming out in such a way that they benefited from it. And if that meant that either the consumer or the provider lost out, so be it. And that's what eventually caught up with them when the regulators got hold of them. Insurance, that works on the basis that there is you're given a subject, motor insurance, house insurance, whatever it is, holiday insurance, dental insurance. It's covering the risk that something might happen. And so you pay a premium, an insurance premium. The insurance company takes that premium and all the premiums it's receiving from all of its other customers, and it invests that money. What it's seeking to do is correctly guess how much call there'll be, how much liability there will be on the level of protection they've provided, and their investments and the return on those investments cover the liabilities that arise. So they're using their balance sheet to enable that process to happen. So with the investment banks, invariably, they'll take that capital onto their balance sheet and then they'll pass it on, they'll make a cut, but they're leveraging their balance sheet. So do the commercial banks. An important point for us, for you, is when you put money into a deposit account at the bank, it is not your money anymore. It's the bank's money. It's on their balance sheet. So if they go bust, and this was the problem in the financial crisis, you lose your money because it wasn't your money anymore. You were just on a promise from them that when you wanted it back or needed it back, they would be able to. In the same way as an insurance company, you're on a promise that they're going to manage their affairs in such a way that if you need to claim, they have managed their finances such that they can pay out. And so insurance companies are subject to solvency checks. Banks are now subject to capital checks to ensure that they actually have enough money to cover their liabilities. Investment management. So this is us. This is what we do. We receive money from our clients, and we describe the ways in which we will invest that money. An important point to note is we're not allowed to put that on our balance sheet. It has to be totally ring-fenced. It sits in custody banks. So these are independent banks who also have to ring-fence the money, such that if we go bankrupt, the money that is invested in all of our products and services is protected. So if you put money in a money market account or an ISA via an investment company, that continues to be yours and is ring-fenced, which is different from a bank. And this is an important distinction between the kind of company that investment managers are and banks. Credit cards, I'm sure brokers, they're just middlemen, financial advisors, similar, they're trying to assess the needs of particular individuals or companies and then derive some sort of solutions for those financial needs, etc. But they're sort of sales intermediaries. So hopefully that's helpful in terms of the distinctions within the investment, the finance sector. I'm not going to dwell on this slide. My point here is really that there are so many roles within the financial services world. Some of them are around making decisions. Some of those are around advising those who make decisions. Some of those are providing professional services to enable these different groups. From an investment perspective only, so putting legal stuff and technology stuff to one side and all the rest of it. These are the kind of roles, and just to sort of give you an idea about the sort of how much deep into the future the decision-making processes are. I'll come on to it again, but I just want to make the point. It doesn't really matter who you are, where you've come from. Our view is it doesn't even really matter the kind of subject you're studying. You can be successful in the financial services industry, and we need, quite frankly, young people with a sort of open mind and sort of modern ideas about kind of how to behave and integrity and all that sort of stuff to come in and help ensure that the industry stays healthy in the long term. Okay, so what is fund management? What is investment management? In essence, it's where we've been entrusted with our clients' money to find ways to invest that money such that the capital will be protected, hopefully grow and potentially derive an income from it. It can be quite tricky. I mean, fundamentally, we're trying to find securities, things to buy that are going to do this. This is the Facebook stock chart. This is 2013 through till that's very out of date, so towards the end of 2016. But this would be excellent, and if our fund managers bought nothing but things that did this, we would be very happy indeed. Unfortunately, it's a bit more complicated than just buying Facebook and standing back. We look for we invest in stock markets. We invest by lending governments money, by lending companies money. We increasingly the firm Invesco broadly invests in the real estate as a property, commercial property. In the UK, we've even directly invested in retail property. There's commodities trading, derivatives. I mean, pretty much any private equity we'll do it all. So Invesco Perpetual. Actually, I just want to go back to the previous slide. One way of looking at what we're doing is that for thousands of years, men and women have walked through the local village market. And as they do so, they have a almost innate sense of discretion and judgment about what they need to buy and how much money they've got and what represents value for quality and the trust and credibility of the pitchers and the stall holders. So they're walking through, and housewives for millennia will have known, right, okay, I've got X amount of housekeeping budget and that means I'm going to get my bread from this stall holder and the cheese from there and the vegetables, etc., and the different cloths and all the rest of it. And they'll know, perhaps if they've got a bit more money, they'll go up the quality spectrum. But they'll have an innate sense of value. They'll know when something seems to have gone up in price. They'll be sensitive to things like inflation. There's just an innate sense of understanding the market because they go into that market every week, and you start to get a feel for what seems like good value. Our investors are trying to do the same thing in the financial markets. So as they scan Bloomberg, as they do their research, they're looking to identify opportunities to buy things that seem like they're at a sensible valuation point. The trouble is we can all buy Facebook now because we know it's big and successful and generates lots of revenue. It's whether at this point it made sense to buy. Did it seem like good value at best stage? What are its cash flows? How good is the quality of the management? What is the company's strategy? How much competitive advantage does it really have? What are the barriers to entry? What are the capital requirements? What are the risks that the firm faces? Increasingly, subjects like ESG would come in, so the environmental, social, sustainable governance requirements. What is the performance of the organisation going to be like there? And these are all factors that we need to take into account as we get a sense for what does a good valuation feel like. It's easy to buy fabulous companies. We want to buy companies or invest in companies or lend to companies that have been mispriced at one point. In essence, you've got 7 billion people in the world with all manner of socio-economic and political systems, millions of companies providing products and services to all of those consumers. How can the market really accurately price the forward valuation of all of those products and services at the same time, all the time? And our stance is, we don't think that is possible. they're in the developed markets where you've got a lot of control over the information that is allowed to be provided. Yes, we would concur that those markets do accurately price the value of securities a bit more regularly. But in developing markets where you've got different levels of regulation, legal jurisdictions, things can be quite fast moving, particularly nascent organisations, new products, services, etc. It's very difficult to be very accurate about the future cash flow value of these organisations or the risks that lending them money represent. That's the arbitrage our fund managers are looking for to assess as we understand the value of those. So I think covered quite a lot of this. This is a plug for Invesco, 6,000 employees, 750 investment professionals, covering equity markets, government, corporate debt, foreign exchange, derivatives. I mean, we'll trade trillions of dollars of foreign exchange every year. Mike will talk about the value of the notional in just his product, commodities, private equity, etc. The Henley Investment Centre, so this is as of the 30th of September 2017, so it's due to be updated shortly. So yeah, by the year end, we're $150 billion. This is all in pounds. Just sort of, so UK equities, 23. Fixed income is our biggest single group at almost 30 billion pounds there. The global and regional equities breaks down into Japanese, Asian, EM, US, and Europe, European equities as well. And then multi-asset, which is the newest bunch, and that's part of Mike's team. Just a couple of comments. The average tenure with the firm of the actual fund managers, 10 years. The average in the UK is nearer 3. So if you go to London, you go to one of our competitors, it's nearer 3. And that's also been achieved despite the fact that our investment community has grown by 50% in the last 6 years. So there's been a certain amount of dilution, which basically means we've got quite a number of very senior investors who have been with us for more than 20 years. We take a very long-term view. We cherish our investment managers and analysts because our view is investment management is a skill. And with any skill, you can get better at it over time by practicing, by getting feedback, by learning your lessons, making mistakes, and having an appetite for continual professional development. So that requires an investment in themselves on their part and also on our part. We spend about $1 million a year on the professional development of the team here in Henley. The value to us, and more importantly to our clients, by taking this approach is the investment management is a skill. It needs the freedom to act. It needs the freedom to express itself. So it's a relatively unconstrained approach. So there's no house view. There's no global CIO, Chief Investment Officer, telling the investors what they can or can't invest in, or setting very strict parameters by which they'll operate to. So they're free to act. They get to make the decisions. The quid pro quo to that, the balance, is we hold them to account. There's a group of people inside the investment centre. There's the independent risk function, where Dilip worked before she joined the multi-asset team. You've got an independent compliance function, an independent internal audit function, all reporting to a board with non-executive directors. So there is a massive amount of oversight to hold the fund managers to account. If they're not demonstrating and exhibiting investment skill in the way that they create their portfolios, they're going to come in for a bit of a rough ride with us. A civilised rough ride, but one that won't ever go away. And so we're not interested in lucky fund managers. we are interested in fund managers who constructed a portfolio based on genuine valuation, whereby our clients' capital, the downside risks are very well understood and protected against, and there is a genuine opportunity for them to make their own. Multi-asset team's only got 4 or 5 because they only joined us. It's a rare thing. We essentially bought that capability by bringing some of the best fund managers of Standard Life into our group about 5 years ago. Launched a new product, and as you can see, it's raised £20 billion of assets under management in just over 4 years. It's definitely the most successful investment product that Invesco globally has ever had, and it's one of the most successful investment products in Europe. No pressure, but Mike's supposed to stop them screwing it up. Okay, this slide is just a plug around the fact that to run a world-class investment management business, you need world-class people in all manner of different functions. So yes, you've got the investment department, there's the product development area, so seeking to understand clients' investment needs, i.e. their sort of financial challenges and how we could respond to that and help them, and then explaining it to clients. I joked with a colleague that, you know, because our funds are relatively unconstrained and we're looking for, you know, companies that are a little bit misunderstood in order to find valuation opportunities, there's a bit of volatility. If there was a film rating agency for funds, we'd get an 18+ rating because there is some sex and violence in what we do from a financial services perspective. That means it needs explaining. We don't really market direct to retail consumers. We want to go via professional advisors and consultancy companies because we want to ensure that the underlying investors have had what we do thoroughly explained to them. And then you've got this sweat. I mean, like, we could not do these things very well, you know, as well as we do without these. So, increasingly, we need very smart people from legal and compliance to find efficient ways for us to work with the regulations, protect our clients' interests, but be allowed to do what we do. Technology, massive subject in the financial services world. Here. Risk, mathematicians, both in all of these areas, but also the risk function, critical to what we're doing. Finance, of course, and then internal audit, keep us protected, and HR. There is a job, there is a role that requires the right kind of balance of skills and capabilities, and that can be derived from, we believe, anyone if you're prepared to work hard enough. I think I've really covered this. So, recognition of personal skill as a source of value, world under one roof, away from the city. That's the point. That, I mean, would you really build a world-class investment centre in a sleepy provincial town like Henley? Possibly not. But it's actually ended up being a brilliant place to have an investment management business because you are away from London. The whole idea is to think independently of what's happening in the world. Sure, we're only 40 minutes away. We stream of information. We spend £20 million a year on independent research that comes into the firm. We go travelling all over the world, meeting companies and talking to central bankers and all the rest of it. We don't have a shortage of information and insights, but we go back to our lovely, quiet, calm, beautiful campus in Henley and think about it independently of what else is going on in the world. We're free to think. A couple of points around the culture. It's quite a diverse team, so the investment community is... We looked at all the degrees that the investment community has, and only 25% are finance or economics. The rest are, well, pretty much everything. Humanities. One of the most successful Asian equity fund managers we've got is Music Tech. One of the most successful fund managers ever in our company did agricultural economics. this is underlying my point, it doesn't matter. It's the quality of your thought, the curiosity, the ability to independently think, the ability to turn things upside down or look at things from multiple perspectives, and having some courage to extract a sense of so what from all of that and back it up. Work-life balance. Yeah, I mean, if you came into the investment floor most days by 7:30, you're going to see quite a few people at their desks. Come back to the department at 5:30, they're starting to fill up fast. It'll be basically the multi-asset camp. There's an on-site gym. We have no problem people getting up at any point in the day and going to a class at the gym or going for a run. People go for mountain bike rides after work and submit themselves into teams for all sorts of sporting events, social events, etc. We really look after our people because they are our performing assets, and it is in our interest to keep that skill inside our firm for as long as possible. This point about ethics and integrity, I was saying from Neil earlier. So for the last 2.5 years, I've been working for the investment department, part of the management team. Before that, I was the chief of staff to the last 2 CEOs. And I saw all manner of interesting situations, and I can tell you, hand on heart, I slept well at night. I did not feel like my integrity or the integrity of the organisation was under stress, and that's because we put our clients first. And it really is quite straightforward, because that then gets reciprocated. So, from an ethics and integrity point, this regulatory push for conduct and sort of looking after clients, we scratch our heads sometimes. Well, what, why else would you do it any other way? So we'll come on to questions and answers after Mike's bit. So I think we'll come back to that. So I think that's me.
Great. Excellent. Thank you.
Great. Well, good morning, everybody. My name is Michael Marshall. I am the risk manager for the multi-asset team. As James was saying, we are quite a new feature of Invesco, and actually quite something that's become a lot more popular since the global financial crisis. This sort of way of investing and way of looking at things and way of doing things has become a lot more important. And one of the reasons we joined Invesco was to plug a gap that they were requiring for that. Not me personally, my team. So just as an introduction to myself, I, like all of you, went to university a long time ago in South Africa. I studied investment finance and accounting. I hold a CFA chartership, and I am Premier certified, so Professional Risk Manager certified. So a lot of studying over the years, which has brought me to where I am now. In terms of employment history, I've worked at a lot of places. Before I found my home at Invesco Perpetual about 5 years ago, and not looking to leave for a lot of the reasons that James spoke about earlier. I worked for a consultancy firm called Sapient, where I was placed at Deutsche Bank and Merrill Lynch. I worked in sort of structured equity derivatives and structured hybrid derivatives. Did a stint out in Hong Kong with them. I worked at ABN AMRO Bank, where I used to write pricing equations for structured hybrid derivatives. So a lot of Monte Carlo simulation type work, path dependency type stuff. I'm told that some of you guys are numbers people, so something that might ring with you. Royal Bank of Scotland, I worked on a legal team there, basically creating products and writing the legal structures around those products in structured hybrid derivatives. Then I left the banking industry and moved into asset management, where I worked for F&C Asset Management, again in derivatives, before moving to Invesco Perpetual. Right. So very broad sort of work history. I've done a lot of things for a lot of different people, and just to plug Invesco, but Invesco has been the sort of best company I've ever worked for. Chalk and cheese among different from the banks, very different working environment, very different culture, very different way of looking at things. And yeah, it's just been great. I've much preferred the buy side, what we call the buy side, so that's the sort of investment side rather than the sell side, which is the banks. Various reasons, suits different people at different times. Yeah, but we can talk a bit more about that a bit later. So I think James has touched a lot on Invesco Perpetual as a whole. The multi-asset strategy. You saw Dilek last week, right? She would have probably given you a lot of introduction to our product. Quite big. We've got 21.2 billion in assets. We run, if you believe the regulator's calculations, about 10 times leverage. It's actually more like 3 because we do a lot of long and short. So we actually at any given point in time running, somewhere in the region of 60 to 100 billion of assets. In terms of trades, we did 22,000 trades last year. So just as an indicative size of what we do, some of our fund managers do 3 trades a year, I think. Yeah. So we do quite a lot of trading. We use a lot of derivatives, and as such, it's quite a fast-moving and exciting environment to work in. So typically, this is our front chart. What we aim to do. Cash plus 5, which is roughly what long-term equities will give you. If you hold equities long-term, you'll earn about cash plus 5%. But we aim to do it, and this is the important bit, at less than half the equity volatility of less than half of global equity volatility over a rolling 3-year period. Okay, and that's why we have on-desk risk managers. Okay, not a lot of funds that you'll see they don't have on-desk risk managers. Risk is sort of an after-the-fact function. They'll run their funds how they want to run it, and independent risk teams or somebody in the risk department will monitor them and make sure that they doing what they're supposed to be doing from an investor perspective. Okay, we actually have on-desk risk people sitting there because our investment philosophy is unconstrained research combined with a robust risk-based fund management process. Okay, so I think Dilek would have talked to you a lot last week about how we come up with the ideas, the sort of the global macro perspectives that we come up with, where all that research comes from, how we come up with some ideas. What we do with the risk side is look at how we can combine those ideas into an efficient portfolio. Okay, so we might have 50, 60, 70 ideas that we're really happy with and we think they're all good. Yeah, how do we combine those? Which ones do we take? What is the mix that we need to do to create an efficient portfolio? We often talk about we don't have the best ideas that we come up with in our fund. We're a fund of good ideas which work well together, okay, to hit our targets. Right. So I think this point here is a robust risk-based fund management process is quite important when understanding what we do. I'm going to sort of try and delve into that a little bit, how we go about doing that. As you guys are finance students, I think students, PhDs, doctors, maths people, I'm not going to sort of delve into a lot of the stuff that we're doing, but please feel free to shout if you have any questions. I don't mind taking questions in between. But yeah, I do talk fast. I do talk with a horrible South African accent, so feel free to stop me at any point and ask questions. Cool. Okay, so what is multi-asset? Right. The obvious answer there would be to hold lots of different asset classes in a portfolio, okay, which is what we call asset allocation. Okay. So back in the day, what you used to do was you would have a portfolio and you would hold some equities, you'd hold some bonds, maybe you'd throw in some commodities in there if you can get hold of them, maybe a little bit of real estate. Okay. Right, asset allocation. We've all sat there, we've learned about diversification, creating, uncorrelated assets coming together to create a diversified portfolio. And that's how it used to be. So asset allocation. How much equities do you want to hold? How much bonds do you want to hold? How much commodities do you want to hold? And how much real estate do you want to hold? There's a few other things. Okay. a lot of this fell down in the financial crisis when basically all these assets moved together. Okay? So people have been trying to move away from asset allocation into more products which offer genuine diversification. Okay? So they'll do that in a lot of different ways. They'll do that by using certain funds as part of a portfolio. So for example, our equities funds may form part of a portfolio and they combine these with different assets. They do things like our funds, which I'll talk a bit more about now. And they buy protection, right? They go non-linear in terms of options and bits and pieces. But the main idea is that it's no longer just asset allocation. Okay? And that's where our fund differs a lot from your sort of traditional funds of funds, some of the global targeted asset allocation funds, things like that is what we think in terms of ideas. So these are global macro ideas or investment ideas that are sitting there. These ideas are asset class agnostic. Okay, so every idea that we have has to have a theme behind it. Okay, so if, for example, we are constructive on Japan, right, that could mean going long the equities, shorting the bonds, shorting the currency, yeah, potentially a volatility trade on that. It's asset class agnostic. It's a theme that underlies an idea, and then we will look later at the best way of implementing that theme. Okay, and this plays a lot into how you get genuine diversification in your funds, and looking at the tails, which we'll come a bit more into in a bit more detail. So as an example, I'll talk a little bit later about how we generate alpha strategies. So leveraging good fund managers, yeah. So isolating good fund managers. Japanese yen versus Korean won. Currently we long yen versus Korean won, so that's an Asian competitiveness play. So the play there is not we think yen's going to go up and Korea's going to go down. It is a competitiveness theme there between the Japanese economy and the Korean economy. Okay, and we've chosen to express that through the currency. We could have done that through going long the equities in Japan and short the equities in Korea. Yeah, but a better play here, and because the yen is a defensive currency, was to hold that, because the yen is anti-correlated with risk, and we generally hold a bit of a risk-on portfolio. I'll talk a bit more about that later.
Yeah,
Sorry, Dr. Professor.
No, I was going to ask that. It's okay, just explain it.
Yeah. So there's a lot of thinking like that. Generally the yen is anti-correlated with everything, right? Because everything's a risk asset. So if you're buying equities, that's great. If you're buying corporate debt, that does well when risk is on. What we've been seeing for the last little while, not so much in the last few days, right? Yen are generally anti that, because when things go bad in the world, the Japanese all repatriate their money to Japan. Okay. Every single one of them, but it's the general flow of money. It's called a risk-off currency. So the yen goes up when the world is going bad. Okay, so that's a great way of expressing this idea, Asian competitiveness, because A, we like Japan, we think it's more competitive than Korea, and it's a defensive play, which is anti to the tilt of our portfolio. Okay, so the idea is completely separate from the implementation. And we use a good idea plus the implementation that we do to make the portfolio robust. Okay. Long EM carry. This is quite an interesting trade, very interesting and very clever. So if you lend money to an emerging market, you generally get more money than from a developed market, right? Okay, it's called carry. So if we buy Brazilian real or Russian ruble, something like that, basically it carries at roughly the interest rate differential between the two currencies you're playing on. So going along something like the Russian ruble against the dollar, you're effectively investing at 18% and you're borrowing at 2%, right? So you carry at 16% a year, okay? Which is great as long as the ruble doesn't plummet and fall 50% and you get in a lot of trouble. Okay, so these are risks you have to sort of weigh out. So we could take advantage of carry situations just inefficiencies in those markets to put trades on. Okay. So again, this is not necessarily, multi-asset isn't just asset allocation anymore. It's not making a decision between bonds, equities, commodities thing. It's actually looking at markets and saying, right, what do we think is going to happen here? How can we take advantage of that particular thing? And we'll talk a little bit more later on about how derivatives help us do this, because that's very important. Derivatives let you pinpoint these risks specifically, whereas in asset allocation you can't do that. I think you have a question. No?
Me? Oh, lots of questions. No, you're okay. You carry on.
Perfect. Okay, so yeah, we can invest in anything really. Currencies, corporate bonds, volatility instruments. Volatility is a very interesting thing at the moment, so we can directly access volatility markets. Okay, that can be very positive, very negative. If you guys have been reading the news in the last couple of days, you'll just see that a couple of volatility products have just blown out. So a couple of short VIX exchange traded funds and exchange traded notes have just completely blown out and lost all the investors' money. 20 billion or something? Can't remember the number, but it's large numbers from basically not understanding the risks involved in volatility instruments. Okay. Equities, of course. We can hold equities, we can short equities. Commodities we can hold a little bit. We don't do too much of that. We do a bit of it, but there's a lot of problems with trading commodity products, particularly in retail funds. Investors sometimes don't like you manipulating agricultural markets and things like that. So we have to be very careful trading commodities, but we can do it. We have strategies with commodities in them. Real estate, of course, we can
Mike,
access.
just a quick question about that then. So do you believe that's what happens in terms of commodities? So that there was a whole lot of conversation, wasn't there, just after during the financial crisis, but of course, along with lots of other assets, agricultural prices went very high, and then that derivative market, sort of people were arguing, translated to the physical market, increasing the price of food, etc., etc. Do you think that's what happened?
I think it can happen. I think it can happen in the short term.
Yeah.
So speculators are a reasonably large portion of every market that you look at. These days you can spread bet, which is effectively a derivative. So we can go and I can bet on the price of corn, but I can't actually myself. You're not allowed to. Not allowed to. But someone could go and bet on the price of corn, or on soybeans, or orange juice, or pork bellies. And in large scale sizes, things like CTAs or hedge funds even can push these prices around. In the long term, generally that washes out. It's normally your hedges which take ownership of the market in the long run. So what these things do is they do create pricing inefficiencies. So supply demand, even oil, for example. Oil's an interesting one. If you look at the supply and demand dynamics of oil, they're a lot different to how the oil price trades. And that's maybe not such a good example because that could be moved around by a lot of other factors, OPEC, Russia talking to OPEC, things like this. But other things can move aggressively, but only in the short term. Is my opinion. It doesn't get out of hand too quickly. And what is interesting about the commodities market is the options market is actually quite dominated by hedges. So your producers and your end users of things, which is not necessarily true in the equities market, for example. So that kind of creates quite good dynamics in that. I could talk for hours on this particular topic. One of the big case studies in risk was actually companies speculating on oil. China Aviation, if you ever heard of that, they would basically start hedging their oil requirements for the jet fuel. Oil is a correlated product with jet fuel, so you can actually hedge your costs quite easily. They started doing that, then they started trying to make money from it because they were making more money from that than other businesses. They thought that they were all very clever, and they got hurt on that. Margin calls came in. They all got in a lot of trouble. I think the CEO might still be in jail. I'm not sure. But just very good case studies in people trying to play around in commodities markets, equities markets, bond markets. If you are interested in that, look up sort of case studies on risk. Yeah, a lot of big companies have gone awry using derivatives, which is why we need risk managers to look at this stuff. You know, we need to assess the risk. We'll talk a bit more about this now. Okay. Right. So if you remember back here, we have a unconstrained research process combined with a robust risk-based fund management process. So what is robust risk management? Okay, and this is how we sort of describe our framework on desk for what we do. Okay, we firstly look at the risk of the fund and individual ideas. Yeah, we look at scenarios. We look at structuring. I'll touch on each of these topics a little bit more, and we look at liquidity. The first thing to do is to combine these ideas in such a way that we create a robust portfolio, okay, and we achieve genuine diversification amongst assets. So what we're looking to do here is take a whole lot of independent risk, okay, a whole lot of assets together, combine them in a portfolio to bring the us to a level of low portfolio risk. Okay. How do we go about doing that? Okay. By the way, this chart will look exactly the same for an equities portfolio. Yeah. Right. You hold a lot of stocks. You know, they diversify each other, and you get a little bit less risk. Okay. With what we try to do is we try to get genuine diversification. Okay. So we'll talk about that a little bit more in the next slide. Okay. So we need to combine ideas to get genuine diversification. We'll just go on to this slide. How do we do that? Right. You guys all know about market bits. Nods? We know market bits? Yeah. I think the 1960s, one of portfolio theory, mean variance. Basic idea is you add uncorrelated assets, okay, or assets which don't have a correlation of 1 together, and that reduces portfolio risk. Okay, so no two stocks are perfectly correlated. So if you have a portfolio of 30 stocks, I think this is how it's explained in lectures, or it was explained to me when I was at university. You have a portfolio of 30 stocks, right? You'll get some diversification benefit amongst those 30 stocks. Yeah. The more stocks you have, generally the more diversification benefit you have. So basically the bigger the line gets. Okay. Unfortunately, it's a little bit flawed, and this is why I'll talk about that a little bit more later. But as you can sort of see, you know, this is the standard CAPM, yeah, capital allocation line. We want to make return without taking risk. Okay. Would you rather have this line here as a return profile, or would you rather have the nasty drawdowns? Okay, so that's the allure of low volatility. Okay, nobody likes volatility. Everybody likes return. How do we get the most amount of return? We're taking the least volatility. Yeah. Okay. So this is Harry Markovitz's mean variance optimization. Now, the problem with this is it's one of the most misunderstood things that I see people talking about in finance at all levels, okay, is that unfortunately this portfolio, yeah, which you guys all know as the efficient portfolio, you can only know after the fact. Okay, so you can only know after it's happened what that portfolio was. Okay, so all the work you try to do to create this efficient portfolio or some sort of diversified portfolio, you'll only know if it's worked after it's happened. Okay, because everything that goes into your models to do this are estimates. All right. But we'll touch on that a bit more later. Okay, so we often get asked, do you believe in the CAPM? Yeah. It's like, yeah, I believe in the CAPM. Yeah, it's mathematically sound if you believe in all the assumptions of the CAPM, or, well, you don't even need to believe in the assumptions of the CAPM for a model to work, right? They're just all assumptions stated by the guy who's made the model. Yeah, it works, but you can only know about it afterwards. And unfortunately, in the world that we live in, we're not looking about things that have happened yesterday or a year ago. We need to try and make things which are going to happen in the future. Okay. So unfortunately, one of the things I will hocker on a little bit about is that all the parameters that go into your model are estimates and unstable. Okay? And that is the rub. Right? If you could believe that the last year of if you could know that the last year's volatility numbers, how the assets moved would repeat themselves, you'd make a fortune. Okay? Because you just know that it's going to happen again and you would just buy the best ones. Okay, we can't know that, so we have to take estimates. So it's all about finding robust estimates and just seeing how unstable they are or how good your model actually is in risk terms. Okay? So how do we achieve genuine diversification? Now, you guys will recognize this equation? Yeah? 2 asset portfolio, very simple. This is basically the volatility of a portfolio of only 2 assets. Okay? Hope that you guys will recognize this. I didn't know. But basically, what this is saying here is that you can put a portfolio together, and the variance isn't necessarily additive. Okay? So you've got to be careful when you look at these things, because adding lower risk assets to any portfolio is going to decrease the risk of that portfolio. Okay? And it seems like a simple concept, but you'll be amazed in the industry how few people actually understand this. Okay? So if I say to you, right, I've got some equities, I'm going to add some bonds to that portfolio. Okay? What does that do to my portfolio? Brings the risk down. Yay, great, my risk is now lower. Yeah? Is that diversification? Not necessarily. Right? They're lower risk assets, added to a higher risk portfolio, that's going to bring the risk down. Okay? That's not diversification, that's de-risking. Okay? If I add cash to a portfolio, yeah, if I have an equity portfolio with 7% risk, and I halve my equity holdings in that, and I add 3.5, and I add 50% of cash into it, my risk will drop to 3.5. Okay? That's simple maths, right? That's not diversification. You haven't diversified out of equities. You haven't got the diversification benefit. The diversification benefit comes from how those assets behave when the other assets are behaving. Okay, the correlation effect, or your assumed correlation here. Okay, so you need correlation to be uncorrelated in order to receive diversification. Okay, it's quite a simple way of looking at it, but it's actually got quite profound effects. Right? This over here is the correlation between the S&P 500 index returns, so stocks, and changes in US Treasury yields, inverted, so it's bonds. Okay, so that's sort of how they behave. Now, traditionally, people believe that stocks and bonds diversify each other. Right? I hold a bit of stock, I hold a bit of bond, I diversify. What most people are thinking there is actually of de-risking. Okay, you've taken a lot of risk out of your portfolio by holding bonds because they're less volatile assets. Okay, you will only get diversification when this number, after the fact, yeah, is lower than 0. Okay, well, you'll get a bit of diversification up here, but the higher this number is, the less diversification you get. Right? So if you look at this particular point in time here, diversification is 0.6. Okay, so you weren't getting very much diversification here. Over here it was minus 0.6, which means you're getting a lot of diversification. Okay. So depending on how your assets behave, will equate to how that to how much impact you get from the correlation effect. Okay. This isn't complicated stuff. I'm sure you guys all know this already. But what this means is that you need to be very sure that you're going to get that correlation if you're hoping for diversification. Right? And that's where it all went wrong in the financial crisis. Everything's sort of moving together. The only thing that helped you was bonds. Okay? Bonds gave you a bit of diversification. That's what's going on there. Yeah, commodities hurt you, credit hurt you. Yeah, so what I mean by bonds is sovereign bond. So if you were in high yield bonds, banks, yeah, bank debt, you felt it. If you were in equities, you felt it. You know, if you were in commodities, real estate, everything fell together. Correlations went to 1. Yeah, correlations were all up here. Yeah, when in the financial crisis. And that was a big problem because everybody was using models where they thought they were going to get correlation down here. Okay. So you've got to watch out with your risk models and be very aware that everything that goes into them are estimates and particularly unstable. Okay. Even these volatility numbers here, yeah. This is S&P index 1 year volatility, 20, 10, 45. Can you imagine what would happen to your actual real volatility numbers if these guys were using, you know, DEC, what's that, 08? What's that here? Yeah, I mean DEC, well, DEC 07 numbers, when they effectively thought equity volatility in all their models was 10, and suddenly spikes to 45, right? Basically, you've got this massive model risk from having estimates that are unstable and, by definition, estimates. You can see right now we're sitting there with an equity volatility of 10. I think equity volatility last year was 6. It was lower than bonds for the first time in ever, I believe. Yeah. Now, everybody who's in their models have a nice, and we'll talk a little bit more about this later, but everybody in their models has 6% volatility going into their diversification equations, their betas, everything like that, right? That's scary because what that means is that all their numbers are wrong as soon as this thing moves 5%. Okay. We'll talk about APT now, how that all works, and it'll come through and what we need to worry about. But one last point I was trying to make on this is and it follows on from what I've just said, is what we've actually been seeing in the last couple of days in the markets. Okay, so if you look at a chart of US equities over the last 5 years, it's gone up in a straight line. Okay, there's been no volatility. Okay, your volatility is sub 10, 6 to 10, somewhere around there, depending on the time frame you use to calculate it. And one of the most popular products in the market have been effectively low volatility products. Okay, so things which take advantage of the low volatility environments. Okay, so you have things called risk parity products, which effectively use these equations to allocate risk. Okay. So before, this used to be an after the fact equation. You constructed your portfolio and you saw what your risk number would be and you were happy with that. Nowadays, people are using this end to solve for that end. Okay, so all the inputs that are in here to solve for that end, and that dictates asset allocation equations. Okay. So whereas before you held a certain amount of equity, a certain amount of bonds, right? Nowadays, because the volatility of equity is so much lower, you can hold a lot more equity than you used to be able to hold. So whereas before maybe you would, because it's called risk parity, you hold the same amount of risk in your different asset classes, right? So you used to hold a lot more bonds than you held equities. Now you hold a lot more equities relative to bonds. So 50-50 say instead of 70-30%. Simple equation. What happens when this all goes up is that these equations rebalance, and now you have to move back to the 70-30 equation of 70% bonds, 30% equities, right? So people have to quickly get rid of a lot of equity exposure, right? And this is what we've been seeing in the market recently. There's a lot of rebalancing of risk parity equations. A lot of sort of, you saw the VIX spikes recently, which have that's basically volatility rebalancing. Yeah, so VIX spiked, caused these things to need to rebalance. Equities sold off, reinforces the equation, right? Because now you've got more volatility, so they have to rebalance more. Sell, sell, sell. Yeah. What happened in 1987? Similar type vibe, right? People were doing portfolio insurance through futures, they got squeezed. Sell, 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 market fell. Yeah. So I'm not saying it's going to be 97 again, but this is the type of thing that we as risk managers have to think about, okay, all the time. Somebody put it quite nicely in an article I read the other day. They say that whereas volatility used to be a thing on the sidelines, it's now on the field. Okay. The volatility number is dictating, so good old Markowitz here is the guy to blame. Volatility in all these equations, people trying to make these efficient portfolios and doing things based around estimates, which are unstable, okay, is now dictating asset allocation decisions, how people invest their money, where the money moves to, so the flows of money. Yeah, it's being dictated by volatility and not necessarily fundamentals like they used to be a lot more. So when that all reverses, volatility is a fickle number. You get these sort of flash crashes, rebalancings of the portfolios, and we need to be careful of how we use volatility and what we use it for. So briefly want to touch on arbitrage pricing theory. I'm sure you guys have heard of APT before. Okay, it's a very simple concept, but one that is used literally everywhere in finance. Okay, people won't call it APT. They won't word it that way, but fundamentally it's APT. Or the smart beta that we're doing at the moment, everybody's into. Betas to asset classes, minimum variance hedge ratios, anything you want is basically APT. Okay, so it's a very important concept to sort of understand. It's a very simple concept, but it has broad-reaching implications, and it's a very handy thing to know. Okay, so implicitly, Stephen Ross in the 70s, he came up with this great little thing. The expected return of financial assets can be modeled as a linear function, important word linear, of various factors or theoretical market indices, where sensitivities to changes in each factor is represented by a factor-specific beta coefficient. Okay? And all this is saying is that, much like a cake can be explained by all the ingredients that go into a cake, yeah, asset price returns or portfolio returns can be explained by a recipe of factors with particular weights assigned to them. Okay? Everybody know about that? Anybody run a regression? Multiple regression? Same thing, yeah? Okay. You have a time series, you run a regression on a whole lot of different other time series. Those are the factors. The beta weights are your beta weights. Okay. Very simple, but we can use it in a lot of different ways. Okay. So just as an example, explaining returns or ex-ante risk. So portfolio returns are equal to the sum of the asset weight times the asset return. Okay? So if you've got 30 stocks in your portfolio in a particular blend, right, those stocks go up, you make money, they go down, you lose money, you add it all up. Okay? That same portfolio return we can explain as particular weight to certain indices. Okay? So if you've got a broad-based, so let's talk about the S&P 500, right? 30 sectors in the S&P 500? About? Sorry, it's James. Call it 30 sectors in the S&P 500, made up of 500 stocks. Okay? So you can also explain the returns of the portfolio by using those 30 sector returns. Yeah? Or a global portfolio of equities, the MSCI World, you can explain by weightings to the individual country equities. Okay, simple, right? Run a regression on it, and you'll probably get quite a good model which explains it. You can do that with any risk. Okay, and this is where it becomes interesting. Okay, you can do factor risks, large, small. You can do it with macro risks, exposure to GDP, inflation, anything like that. And it's not that you're trying to necessarily explain the portfolios, but what this shows you is it shows you the weighting of your risk to those particular factors. Okay? Particularly relevant to the multi-asset portfolio. Okay? If you've got a UK equities portfolio, probably about 80% of your risk is explained by your market index. Okay? In our funds, it's probably less. It's probably about 60 to 70% because we so off benchmark. Yeah, but for most equities portfolios, you may as well hold the index. It's cheap, and you can explain most of the risk by basically the index. Okay, most of them you can replicate it. Yeah, so this has far-reaching implications for how you replicate portfolios. Okay? If I want to get rid of a whole lot of equity risk in my portfolio. Right, I can either sell all my stock or I can short a future. Right? Much easier to short a future than to sell all my stock and then rebuy it 3 months later when that risk event's passed. So using this type of stuff can give you a lot of insight into your portfolio, and it can give you a lot of like practical weightings and ratings to risk that you can use to make decisions, but also to basically play around with your portfolio to access the risks that you want to access and not access. Okay, and this type of thing, you'll be surprised. This is basically like all of finance these days. It's just working out different risks, different things. You'd be amazed at how many questions I get from clients, which is just basically answered by arbitrage pricing theory. One thing to note, and it's also a very important thing because we use it a lot, is that there is I have this equation exactly right. There is a solve factor for the return that cannot be explained by the factors you're using in your model. Okay, and that's very, very important because that's your basis risk. Okay, so if I'm trying to explain the risk of one of our fund managers' portfolios relative to its benchmark, okay, the alpha is going to be quite high. Okay, you can also add anything on the end, an error term about how much it all comes, but basically you just have an amount which these factors don't explain. Okay, and that's quite important because we can actually isolate that. We can take positions to isolate out that factor there. For example, how good a fund manager is. I'll show you how to do that later. Another good use of this is principal component analysis. Okay, it's a nice thing, PCA, and it's quite efficient in a lot of ways. I personally haven't found very many uses for it other than to explain that we are correlated or we aren't correlated, so we are diversified or we aren't diversified. Because principal component analysis is sort of like the opposite of what we're trying to do. So we're trying to be diversified, right? Principal component analysis works very well in systems which are correlated. Okay, so if you want to look at a system and you want to use your principal component analysis to decompose that, if you looked at our fund, it's basically like we've got weightings across the spectrum of all the PCAs, which is exactly what we want to have. But those don't actually mean anything to us because they aren't correlated with anything and they're just statistical numbers. So you guys know PCA, right? You guys have used it a bit. It's basically like exactly the same thing as this, except you break up your risk factors into uncorrelated risk factors. They're just statistical, for lack of a better word, time series that are uncorrelated with each other. Okay. The problem with using sector factors, sector weights, for example, is that all sectors are basically correlated. Yeah, and they have because they also have the same risk factors driving them, or a subset of the risk factors which drive the sectors are all driving each other, right? Beta and stuff. With PCA, you break it down. You say, okay, well, how many uncorrelated risk factors, or these correlated risk factors? When you're looking at financial time series, it's all sort of risk on, risk off. So you'll see the primary factor is risk on, risk off for most portfolios. Second one is sort of some sort of convexity effect. It is very useful if you're trying to do things like scenario analysis and you need to shock interest rate curves or volatility curves or things. It does become very, very useful. But in a portfolio context, it's a great way of basically showing that you are diversified, because you just basically say, like, look at our factor weightings across all these PCAs. We've got nothing, no one is dominating. We've got like a lot of different factors driving our portfolio that are uncorrelated. Whereas if you did a PCA like this on an equities portfolio, there would be like one or two factors driving that portfolio. Yeah. Quite useful in explaining diversification. If you want to look at that, read the stuff by Mayuchi. He's got a lot of really good things. I think some of the stuff for the future will come from this type of, so moving away from things like volatility and value at risk, and moving more into some of the stuff that these guys are talking about now. Number of uncorrelated factors in the portfolio through time, stuff like that is very interesting. I'll show you. I think I've got some slides on that a little bit later.
Yeah, I mean that's very interesting. I mean, of course, one of the criticisms of arbitrage pricing theory is it's a theoretical. When you do principal component analysis, you don't really know what the factors are, what they really mean, and although they can tell you about diversification, they can't really tell you much else.
Yeah.
And the other criticism, of course, which is your sort of CAPM criticism, is that when you're estimating those things, you're using historical
Yep.
data,
Yep.
aren't you? And so it's it's looking forward again in timing, which must be a thing for you, which you're thinking
You're
about.
stealing all my thunder here. It's,
I'm gonna
it's
show
not
that.
good. It's not good.
Very interesting.
Good. But yes, no, it's exactly the point, right? All of this is, that's why I underline that. I keep saying it. Everything is estimates and everything's unstable. So it's very easy to sit there and go, my VAR is, and it's very easy to communicate. My value at risk is 2%. Right? Clients love that. Cool. Value at risk is 2%. According to which model? Whose model? When was it taken? What are your inputs? Like how are you pricing those assets? It's linear. Does it take into account convexity? Does it take into account non-linear assets like options? So a lot of these models are good for a lot of things, but they're also very bad for other things. And it all comes down to those estimates, unstable, and modeling. Like if you could perfectly explain, a portfolio's return, so R squared of 1, like say, nothing else in there except by sectors or index weights. Why'd you hold the stocks? Just do the futures, replicate the portfolio, and then your fund manager basically adds no value to the process. Right? You can do a lot cheaper yourself, or buy an index tracker fund. Buy a couple of index tracker funds and you can replicate his portfolio. Okay, so you could say that, but that's not the case because there is always idiosyncratic risk underlying that. These models are just models, and they just give you an idea of what's going on, and they'll give you, especially the risk factor weightings. Any sort of risk factor weightings we're looking at here. For example, we look at the beta to the dollar a lot. Like what's our weighting to DXY, the dollar index? It gives us a bit of an indication. As to our tilt to the dollar or away from the dollar. And the dollar is actually a very interesting one because it behaves very differently in different market environments. Okay, so if you just think about the States, when you risk on, so when everything's going well in the world, everybody takes all their money and moves into America because America is growth 500, right? We love America when things are going well. You see now, right? All the assets moved in there. When things are going badly, everybody moves their money into the dollar, right? Because we're a better place to park your money than in the States, which is the biggest economy in the world, nice and safe. They go and buy U.S. government bonds, so that puts pressure on the dollar and it pushes it up. So both in very good times and very bad times, the dollar is appreciating. But what happens in the middle, right? And that's when people are like hunting for other things to invest their money in. They're hunting for yield. And they'll move their money out of dollars into Europe, into Japan, into Korea, wherever, right? And then you get this, what we call the dollar smile, which is a heavy risk on, heavy risk off, somewhere in the middle, and you need to try and determine where you are. If you're suddenly in an environment where your models are all basically saying heavy risk on, because we've been in a heavy risk on period for the last year, 2 years, 3 years, right? And everything changes, and you shift to heavy risk off, you might be okay. And everybody after the fact goes, great, we were all very clever but they don't understand the reasons why that's moved. If you move into another benign period, then the dollar suddenly goes down and you get smacked, right? Because you're holding dollars, okay, which is not what you want to do. So you've got to understand your models, you've got to understand what these things are doing, you've got to understand what estimates are going into those models and how unstable they can be, and what happens if those correlations break down. This is a very simple equation because it's got a 2-asset portfolio. If you expanded that out, I should have actually put this on here. In our portfolio, we've got over 2,000 lines. Okay, in our portfolio, probably representing somewhere in the region of 200 specific positions on different risk factors. Okay, so now we've got a 200 by 200 correlation matrix. Okay, how many assumptions is that making? Right. What is if one of those breaks down, or 2 of them break down, or 10 of them break down? Yeah. Right. So we need to be very, very careful about the models, and that's what Mr. Keller was saying about the criticisms of APT, criticisms of CAPM, criticisms of gauge copulars, if you want to go into it, to that level. They're just a model and they will show you what they're doing. We are constantly always trying to find better ways to try to represent risk. and you kind of have to be doing that. Keep up with the literature, figure out what other people are doing, read up on the stuff so we can see what could go wrong, but more importantly, just know the models and know what they're trying to tell you and know their limitations. Sorry.
So the other assumption is linearity, right? One
Yes.
argument that I've heard about using machine learning models is because it breaks the linearity assumption. What do you
But it
think
has
of
to
that?
make thousands of other assumptions to break those assumptions. But yes, linearity is a bad assumption.
Mhm. So what's your opinion of this machine learning model? Is it,
I think they've got a way to go. I think they're quite big news at the moment. The problem with machine learning is data. Okay, because it's the same with everything, it's data. Right. We haven't seen every market environment that can occur. Right. You can't get, for example, before 2006, I cannot find a time series which represents implied volatilities. So I can see what's happening in the last 11 years with implied volatilities, what they've done, what they did through the crisis, what they did through 2016, what happened in Brexit. But I can't see what happened in the tulip bubble, or or in 1987 when everything went bad. So I have to guesstimate that, right? I have to try and build a model to make that data for myself. Okay, so there's lots of ways of doing that. I'm sure you guys know better than me, how to manipulate time series to work. You could look at the implieds and then try and estimate something else, but you don't know what's going to happen. Yeah, this VIX event that's happening now is a unique event that we've never seen before. That's just happened in the last 5 days. Okay, so how's a machine going to have learned that? Now you say, okay, now we throw that into the model. So now he's learned something else, but how does that change everything else that's come before? Which is why, in my opinion, machine learning will never take over active management of funds. They'll try and go. But okay, so Bitcoin's a great example. Okay, everybody was in Bitcoin and it was a genius for investing in Bitcoin. I'm sure a lot of you guys did invest in Bitcoin because you are young and clever, and I should have done it too. But what happened to that? Okay, everybody will say, "Oh, this is not a bubble. This time's different. This time's different. It's a different product. It's a different thing." As soon as they try to make it a real currency, regulators came in and smacked them and said, "No, you can't do that." How does a machine know that that's going to come? How can they say? It can be clever, but it's all about the data then, and it's that garbage in, garbage out equation just taken to a new level. You can write algorithms to try to take out the garbage. You can write algorithms to try and manipulate it or put it in. But at the end of the day, you come back to exactly the same problems. Everything that goes into those models are estimates, and they're unstable, and they can change at any point in time. Not to say that in most cases it might not be better than most active fund managers, but
I wasn't suggesting to take over the active manager, just as a support to make decisions instead of APT.
Yeah.
Because,
Oh yeah. I mean, so I say APT. Yeah, there's thousands of models you can use,
Yeah.
different models. We'll talk about some of them.
From a
now.
regulatory point of view, I mean, I think I've used a bit of machine learning in terms of predictability and things like that, and it's quite interesting. But from a regulatory point of view, the things why these models are reasonably attractive is you can see what's going on. I can
yeah,
even
you
if it's
understand.
lines and lines and lines, I can see what's going on. The difficulty with machine learning is when we talk about distributed ledger, it's what is going on. And regulators can't see that, so to speak, because you don't know.
Yeah.
So, it's another difficult thing, but interesting tools.
Interesting tools and useful tools, and a lot of this stuff can actually give you an edge in what you're trying to do. And we do a lot of stuff that a lot of other funds don't do, which gives us an edge and gives us a different viewpoint. But we always talk about all of this risk stuff that we do as a quantitative input into a qualitative process. So we are not driven by the risk models. I do optimization, on our ideas and the risk things. But that in no way, all that does is give us an indication of what could be a good thing to potentially move around. It doesn't necessarily, it will never drive our decision-making process. It'll just be an input into the decision. I think that's the point you're making, is that all these things are great tools. I'll talk about a few more just now, which sort of help with this linearity problem. Because linearity, the way I see linearity, it has a couple of issues. Is in that when you look at a correlation, it assumes that assets that are correlated will move in a particular way, the same way up as they move down. Okay, which is not the case. So if you look at something like large cap and small cap equities, they generally move up at similar paces in the States, but when they fall, small caps will move aggressively quicker than large caps. Okay, so you could say your downside beta is a lot bigger. Yeah. Swiss market index is a great one, right? It tracks upside beta similarly to Europe, but a similar ratio. But on the downside, because Switzerland's a safe haven, it's a lot more protected than, say, for example, Germany, which is heavily geared towards global trade. So you'll see the DAX fall a lot quicker than the SMI, right? So these types of things you always got to keep an eye on. So linearity is a problem. Most models also assume normality, right? So normal distribution, which I don't think I need to tell anybody is a very, very bad assumption, because the tails are where you really get hurt. So what's it? Leptokurtic distributions. Most things have leptokurtic distributions. Yeah, and it's the 15% event when, you know, a standard deviation is 1% that really hurts people. Yeah, and you got to be on it. You got to be on it. Like, watch out for these types of things. So, no, very good question. Very good question. Another point I wanted to make on that. Oh, and yeah, linearity doesn't take into account option structures. So what happens to your downside? So if you're holding a call option, you're not as worried about downside risk as you are about upside risk. But most models will basically try and approximate options with their delta equivalency in futures or delta 1 instruments. So if I'm holding an at-the-money option, it looks like I'm holding half a stock, and that's a big problem in most models. So yeah, good question. Okay, so this is just an example of how you could potentially build a portfolio using APT, and this is even if people don't say that they do this, this is fundamentally how you you're just decomposing risk into your assets. So these models, how they generally work is they will get factor loadings so use principal component analysis actually to get factor components to various risks. Okay, then they will reverse engineer that back onto the assets themselves, and they will say, well, this asset has X amount of a risk based on these factor loadings, and you can decompose your portfolio quite easily. Okay. There's other ways of decomposing your portfolio, but this is very efficient and works for very big portfolios. So APT, great system for doing that. We actually do this ourselves. We have a system called APT. It's a SunGod system that does this for us, and you'll get something that looks like this. Okay, so you can break down your portfolio volatility. So say this portfolio has an expected volatility of 3.7%. That's broken down between these 28 assets. Okay, and you can see exactly which ones are contributing the most to that. So in a portfolio like ours, this works really well because we can say, okay, which of our ideas are contributing the most risk? Okay. If we know the return or we know our expected returns, okay, we actually call them return expectations of those ideas. We can then say this is a risk-efficient idea because we've got in the portfolio, we expect it to make X amount of return, and it's contributing very little risk in this model to our top level equation. You can also decompose using APT, basically betas to factors. So you might want to say, what's our beta to global equities? Okay. These particular assets, or in our case ideas, this is just a random set, this is not a portfolio by the way. So these assets here have contribute quite a lot of beta to this particular index. So if my investment idea is that I want to be structurally long this index, yeah, I should be holding more of those assets and less of those assets. Yeah, so I can manipulate my tilts by manipulating my weightings to these different assets. Yeah, very simple stuff, and that's all based off APT. You're basically just manipulating your factor weights here. Yeah, to basically create your tilt. So this is why it's quite handy. So in this case, we are quite well. There's actually very low numbers, but we've pretty much got a tiny amount of beta to index 1, a little bit to that. Maybe this is a currency, we've got a small amount of beta to that currency. And we can even look at things like inflation, GDP, US GDP, interest rate curve shifts and tilts. We can look at all these different factors and see our exposures, or the exposures that are implied by the model. Okay. And for all the reasons we have to be quite clever about that. Okay. So a good way of looking at the portfolio. That's obviously an equity index, and those are equities. Just saying, but yeah, that's the yen. Right. So these are some equity holdings. That's a yen holding. You can see that takes out beta to the index because it's negatively correlated with the index. Cool. We're pretty happy with that. Quite simple, quite easy, but this is actually how portfolios are constructed in real life in the market. Yeah. Particularly things like smart beta. So smart beta has been a great product. It is a good thing. You know, if you want to tilt your portfolio to something like value stocks, right? This will give you quite a good idea of how to do that, because you can actually isolate out that factor about how much sort of risk we have. In very diverse portfolios like ours, we actually have very little at this point. The models imply very little betas with just about anything, but we do use it to tilt our portfolio one way or the other: equities, bonds, currencies, so on and so forth. Oh, sorry, I'm waffling on here a bit. Okay, so this is just some of the things to watch out for. I think we've talked about this. Yeah, assume linearity, we discussed that. The normal distribution, okay, it's a great one, and I'm glad you touched on the topic of regulation, okay, because the regulators need you to produce a VAR number, okay, value at risk number. But value at risk in most models is actually just standard deviation, because parametric risk, you know, is just basically standard deviation times 2.6, something like that, to give you a 95% VAR number. And so, because of a normal distribution, it makes everything mathematically easy, but you don't actually know what's going to be happening necessarily in your tails. Okay, so metrics like CVAR, the conditional VAR, which is the average of the tail, so like worst case outcomes, these are a lot better. Okay, but if you are mathematically implying these numbers, you've got to be very careful in terms of what they really mean. What VAR is great for is sort of benchmarking big risks and talking to your stakeholders. So if you need to talk to somebody who knows nothing about risk, you can mention to them VAR, and you can say, well, the models are saying that you've only got a 5% chance of losing more than this number. No, that's great. Yeah. But that's not the full picture, so we do have to be very careful. And we're very careful on this, like at all levels, at the portfolio level, but also at the ideas level. So we're looking at all these things and saying, how much could this idea potentially hurt us if we're wrong? You know, if we get into those far left tails, how much could they potentially hurt us? We need to be clear about it. And then just what I've been saying the whole time, models will look different when they see it with different data. Estimates are unstable. This over here is a portfolio. I just ran it through one of our models, which just shows you each dot here. So this is the portfolio level volatility through time. If you see it with the last 252 days of data, you can sort of see if you seeded with any of this information, the portfolio level volatility goes up. But all the risk models we're seeing at the moment, we're seeing that number there at the end. That's the only number we're seeing, which is very artificially low if you move back into any environment that we've seen previously. Okay, so know your models, know the limitations of your models, and yeah, just look for anything that could happen. Because we're running a portfolio that needs to run at half the level of global volatility, yeah, we don't want to exceed that. We're quite interested in how it behaves relative to global volatility over here. So you can see in 2008 volatility spiked out. Our portfolio volatility also jumped, yeah, in these situations, but it was a lot smaller. You can't see the numbers here, but have a look at them. It's clearly less, right? So what I'm getting at here is I'm seeing from something like this that my portfolio is going to behave at less the volatility of equities, no matter what I see the data with. Okay, so even if we get a correlation environment like 2008, yeah, I will hopefully be at less than half of equity volatility when we come there. Okay. This is just something we look at. This is just a beta. So this is something to be careful with beta. It's a similar thing to this. If I look at beta through time of a particular portfolio, it can be anywhere from 20% here to 0%, and your current model is telling you 10%. Okay, so what's your beta? Okay, that's the distribution. That's basically that in the histogram. So you're looking at, we definitely have a tilt to equities, right, in this portfolio, because we're all to the right of 0. So we know that we'll have some beta to equities. We just can't be sure how much and when, because we don't know now what the next year is going to be like. These are just best guess estimates and those bits and pieces in color here. But these are sort of the things that we're actually looking at in practice to try and determine where our tilts sit. You know, even an equity portfolio you could do this for, and you would see that it has a beta to between 70 and 90. Yeah. So you can do all these metrics. This is stuff we watch out for. Okay. So is that just risk? I'll have to fly through this. Sorry. Okay, scenario analysis, very important to what we do. This is looking for the tails. Your risk numbers give you a good picture of the middle of the distribution, so what you sort of expect is going to happen. But what happens if those correlations don't hold, or you know, something unexpected happens, or something new happens, you know, something that you haven't seen before happens. You want to see how your portfolio will behave. So there's a couple of ways you can use scenario testing to do this. The first one of my personal favorites is back testing. You just basically run your portfolio through old historical environments. Okay, and what's quite nice about this is it basically helps you understand nonlinear products a little bit better. Okay, so if you've got options in your portfolio, running it back through time and actually simulating what would happen in those environments can give you an idea of your actual value at risk or your actual volatility numbers. Okay, whereas a linear model potentially won't do that. Right. So if I ran this portfolio through time, I can see that my sorry, I should explain this chart. Each dot in this chart, or each point in this chart, is a simulation of a 1-year rolling window through time of a particular portfolio. Okay. So this point in time here was the last year back. Okay, what would have happened to my portfolio in the last year back? I would have made 4%. Okay. That is, looking back a year at this particular time, is minus 10%. So since 2006, the worst outcome for this portfolio would have been minus 10%. Okay. I can then take percentiles of this and actually see what my actual bar is. The 5th percentile of this is just a 5% bar. But to me, that's a lot more accurate than a parametric bar, because this takes into account all my option structures. Yeah, it takes into account volatility. It takes into account sort of carry is another great one, right? No model is going to take into account the carry, so dividends from holding the portfolio, currency carry, things like that. So I can actually simulate this back through time and see what it's doing. In this particular portfolio, I'll tell you, it's not a current one, but we had a very large upside structure in place, which took advantage of market movements upwards very quickly. So we had a lot of gamma in the upside of the S&P just because of how low volatility was. We could price it. Got some slides and structuring I'll talk to you about. But basically, it managed to pick up these big moves, basically the big pullbacks from 2009 very nicely, and pushed us up to plus 20%. Would you get those returns? Potentially not, but it does give you a bit of a better picture than just a VAR number or just a variance number. Yeah. You can put your portfolio through historic events. So this is one we get a lot in the fund. People always ask us, what would your portfolio have done if you went through 2008? If you went through the Asian crisis, 1987, and there's a lot of really fancy risk systems which will do these shocks for you. They've all got them in there, they'll do all these shocks. But the problem with most systems is they're linear, right? So don't take into account the optionality that you have in place, or we call it convexity. And what's actually really interesting about that is that most portfolios, whether they be hedge funds or I say like anything which fundamentally sells vol, you've got a convex portfolio. So they behave a lot worse in down moves than they do in up moves. Well, so they lose a lot more in down moves than they make in up moves. You sort of got a convex profile. Looks like that. Yeah, when it should look like that. Because they're effectively short vol. Because they've sold volatility up here. Yeah. At the exchange of basically losing money over there. Okay. This is anything like low beta. You guys have all heard of low beta smart beta funds. Okay. It's that same sort of situation we were talking about where you don't have upside. So low beta products will look really good when the market's going up because they're low beta, low volatility, and they're making good returns. Yeah, but when the market falls, they fall just as quickly as the as non-low beta funds. Okay. So we see a lot of this coming on. That's for that. So historic events are a bit tricky. So watch out for that. Be careful of using instantaneous shocks if you're ever doing this type of stuff. So most models will imply, and even our models imply, sort of an instantaneous shock. Okay. That again doesn't take into account things like carry. The 2008 financial crisis took like a year to unfold, a bit more, right? So what would have happened to your dividends, your interest rate carry, your bond coupons, things like that. It also doesn't take into account optionality, right? Because instantaneously you get the shock in your portfolio, right? And you holding 1 month puts, it looks really, really good, okay? Because you've got this 1 month put, which is just like protected you for the whole ride down. Is that really going to happen? You've got a 1 month put. This thing's taken a year and a half to get there. You're going to have to constantly roll that strategy. You're not going to get those returns that you think you're going to get. Okay? Similarly, if you shock portfolios up and you're holding a lot of short-dated call options, it's going to look like you make a lot of return. Right? That's not necessarily the case. So the challenge there is to try and model path dependencies, strategies, like if you are planning to do this particular strategy for the next year, what would that look like? And that we'll talk about quickly here. Just briefly in scenario analysis, we just watch out for the possible swan. Don't only use one correlation matrix when you do it. Look at it in different correlation environments, or try and pick a correlation environment that is going to be indicative of the move that you're trying to imply. Okay, so we come up with a whole lot of potential scenarios that could happen, and we try and we run them through our scenarios models using lots of different correlation matrices, which imply the other shocks. So we might look at something like the S&P down 50% and treasuries, that's yields down 100 basis points. Okay, so that's basically equities down, bonds up. We'll then use that shock to imply the shocks of all the other assets in the portfolio, what would have happened then, based on a particular correlation matrix. Okay, and we get a distribution which looks like that. So depending on your correlation environment, we could have either made 3% or we could have lost 4% at fund level. Now, I mean, it's anybody's guess what your correlation environment is going to be like when that happens. But we can use some metrics to try and work out what the best guess of that is. And we do that to sort of get a point estimate of, we think we'll lose about 1% if that event happens in our fund. So again, it's knowing your model, knowing how it works, worrying about the instantaneous shocks, modeling your strategies correctly, seeing what's going on to try and get to some usable data. Because to me, if I get a number which just says 3% and I know nothing about the model that's been used to generate it, what the correlation environment was like, are we using the last year's worth of data was not a shock like that. It's just been straight up equities. bonds have been doing pretty well. So, you know, why would that be indicative of an event like this to me, and any use to me in my situation? With something like this is a lot more interesting because I can A, see the distribution, and B, I can sort of make a best guess based around what I perceive to be a correlation environment that will match that in there. Sorry guys, I've got 5 more minutes here. I've been waffling on a little bit. Yeah, Monte Carlo simulation. This is one of my favorite things. This helps you look at non-linear portfolios, so option portfolios or option strategies. Helps take care of that quite nicely. Basic idea: simulate a path. You simulate 5,000 different paths based on some assumptions you make, and see what your portfolio will do in those various environments. You get a distribution again of what could happen. More interestingly, you could get something like that, which just shows you that it's basically the strategy might be a lottery. You don't know what's going to happen. These are the outcomes of the strategy against the outcomes of the asset. Okay, so I actually used almost this exact chart to disprove an idea that a broker brought to us about doing something. I was like, well, yeah, you as a fund manager, do you want to put that in your portfolio? Right? You're basically taking a bet which could go anywhere. You could be right about the direction of your asset and still lose tons of money. Yeah, or you could be wrong about the direction of your asset and still lose tons of money. So we can do some Monte Carlo simulation to sort of try and figure out what might happen in option structure, or if you want to sort of stress models or let data float in your models. So this is the one we use. Actually, we use sort of a gauge model to build this, and Copley and Pareto tails and things to try and take into account non-normal distributions. I'd love to talk to you about this for hours, but unfortunately we don't have the time. And then sort of the last most important thing is when we're looking at ideas, we're trying to make the ideas themselves behave as efficiently as possible. Okay, this is the last sort of thing about our risk management process. So this is mainly using things like option structures, but it's largely using derivatives and option structures in terms of getting efficient access to markets, leverage, shorting, taking non-linear exposures. Okay, so as an example, if you are a long-only bond fund, okay, you have to buy bonds. Okay, and the risk of a bond is made up of the credit risk of that company or that country or whatever, and a risk-free rate, some risk-free rate underlying it. You have to take both those risks if you're a long-only fund, right? Because you can only buy a bond. So if interest rates suddenly sell off, right, or government bonds suddenly sell off, your portfolio is going to get hurt. Okay? So what you want to do is either isolate the credit risk in that bond, yeah, or the interest rate risk in that bond. But let's just say we want to isolate the credit risk. We can do a CDS on that bond, yeah, which just gives me access to the credit risk. Or I can hedge out that risk with another derivative, like a short future. Okay? It's very difficult to short physical assets. So these sort of structures are quite important. So we do this a lot in terms of isolating out risks. So remember we saw this before. I have to go back. Sorry, I've got literally a minute left, don't I? We talked about this alpha here. Yeah, the asset return is explained by factors and some alpha equation. We can basically extricate out the alpha of a portfolio manager by going long the stocks that portfolio manager is holding and shorting the market. Okay, because the difference then is basically the fund manager's skill. Right. So that's APT in practice there. Yeah, we do that. You can do that in bonds, you can do that in anything. Comes to this equation, yeah? So if we go back here, change this up and say, yeah, risk of the market plus his alpha. We do a derivative to remove the risk of the market, and we're left with the fund manager's alpha. Okay? And if we trust our fund managers, is one of the good things, we've got very good fund managers in Invesco, we can take advantage of that type of stuff. And it's a great diversifying factor to other things, particularly since we're such like deep value or heavy value people. We can get access to markets quite efficiently with derivatives and target the exposure. So I mentioned volatility before. Yeah, that's the S&P, I think. That's the volatility of the S&P, right? We might want to get exposure to that. Yeah, often a good tail hedge. So if markets are falling,